Hello, and thank you for joining us today with our webinar on split dollar loan for community banks. My name is Scott Richardson, President and CEO of Izale Financial Group. Before we begin, allow me to spend a few seconds on who we are. Our mission is very simple. We want to help our clients value people. We've done that over the years through the design and implementation of over 1,100 benefit plans for executives and directors. We help you improve earnings. Primarily, that's through programs such as BOLI. And as of end of last year, we service over $2 billion in cash surrender value. And lastly, help you protect assets, things like key person programs, succession programs, long-term disability, supplemental life insurance benefits, and much, much more. If you've seen any of our how to pay your CEO type of webinars, this particular slide is familiar. The idea is that you need to look at total compensation and really focus on the three individual legs. Today's piece is really just about one element and really one small element of the wealth accumulation leg. Before we get too far, I'm going to make some suppositions here that you've done a targeted retirement income analysis to help identify or quantify who in your organization should be considered for benefits and where to start in terms of quantifying how much you should design and offer them. A targeted retirement income analysis is basically you determine a reasonable percentage of final income that you want to replace from bank paid programs. When you do that, we ignore voluntary contributions. They're irrelevant for this purpose. We only want to focus what the employer is going to put into all programs for all employees. There's no single one approach to this. We've got clients who look at this and say we want a percent per year for a position, regardless if they've been there for 5 or 30 years. We've got others who say they want Y% for every year of service they give to the organization. Each one has to come on its own terms. And obviously there's typically offsets in some of these things, half the Social Security benefits, 401k, profit sharing, those things that clearly can be sourced back to funding by the employer. Here's an example of what a targeted retirement income analysis might look in terms of the end result. You can see that there's an executive who's currently 50, about 34, 35 years of service at retirement age, and we have a replacement target that results in a shortfall of about $98,000, and we're going to call it $100,000 for round numbers for the rest of this presentation. Again, no one size fits all. The key for this process is you want it to be repeatable, rational, and defensible. To best understand split dollar loan, it helps to put it in contrast to what people are usually more familiar with, and that is a SERP, or a supplemental executive retirement plan. In its simplest description, it's a mere promise. Employer, the bank, agrees to pay to the executive some dollar amount when they get to normal retirement age, and other distributions can occur for death, disability, change of control. It is a mere promise. The participant is an unsecured general creditor of the organization, so they have to be there to pay it, if you will. And because of that, there is no income tax due until it's received, even though they can vest in it along the way, and FICA tax can be recognized accordingly. GAAP does not allow the employer or the bank to simply wait until the day comes to start recognizing this for balance sheet and income statement purposes. You have to start now. The moment you enter into the agreement, you start accruing for the potential liability. So it's annual expenses on your income statement, liability on your balance sheet. If you're a C Corp, you can also offset that with a deferred tax asset. But the accounting is pretty clear on this. And at some point down the road, obviously when received, got income taxes from the executive, that's when the real deduction gets in for the organization. I referenced the Tax Cuts and Jobs Act of 2017, limited deduction there. You may be aware of this, but in that 2017 Act, basically compensation that exceeds $1 million for certain officers is no longer deductible. But that only applies to publicly traded employers. So for the vast majority of community banks, it's a non-issue. Just be mindful of that. If it doesn't affect you today, maybe some organizational changes down the road, it could come into play. So here's what that SERP accrual might look like. Again, keeping in mind that 50-year-old executive, 34 years of service, and we're talking about $100,000 a year for 20 years. This is the potential accrual schedule based upon current, discount rates, if you will, and whatnot, but it's $42,000 of gross expense. C Corp, you get the deferred tax asset of $12,140, and you can see the first year's P&L impact is a net $30,309, and so on. That $42,449 is the liability on the balance sheet. Again, would be offset by the deferred tax asset, but that's the liability side. And at the end of the day, if the executive stays to the retirement age, gets all 20 years of distributions, the net cost of providing $2 million in benefits to the executive is about $1,428,000 to the shareholders, because it's deductible at the bank side. The challenge and the limitations that we have always had with SERPs, and the varying degrees of emphasis on them over the years, but obviously there's an accounting one. It has an impact on bank earnings, as we just showed. In an era where earnings are challenged still, margins are getting tighter, it's nice to see interest rates perhaps starting to sustainably rise, but it's still going to be a challenge for a few years. We also have this accrued liability that's visible on the balance sheet. On the executive side, we've got the taxation issue. Ordinary income tax. All of these benefit payments when received in retirement are subject to ordinary income tax as they're received. And it's a real question as to what tax rates are going to be down the road. We're at a lowest point in terms of marginal rates in maybe 70 years. We just put $3 trillion of stimulus to work, so there's an awful lot of conversation and chatter about those rates rising down the road. And you can see that $2 million in gross benefits, if it's taxed just at 32%, it's 640,000 of that is eroded to taxes, and the net is what's left to spend. And of course, both parties recognize FICA for those amounts as they're vested over that working life. And lastly, benefit security. And this is really two prongs. So the first one is the bank's got to be there to pay it. In an absolute scorched earth scenario, bank fails, the executive doesn't get a dime. You're an unsecured general creditor, very unlikely to get anything anyway. And those, thankfully, are very rare. But what happens when you have a typical change of control? In this, obviously, in this day and age, when M&A activity is on the rise, that is something you can't discount. And a couple of thoughts on there. One is, where are you on accruing for that benefit? Have you fully accrued for it or not? Will you ever get the full accrual for it if you're the executive? Oftentimes, buyers aren't interested in stepping into the shoes, if you will, of the current sellers, and they would just like to purge these liabilities, purge these benefits off their balance sheet. And so it results in a lump sum payment. So the executive doesn't lose anything, but they get a lump sum, which at least for that year puts them in a higher tax bracket. So they're paying more taxes percentage-wise than they might otherwise. And their ability to replicate the income stream, to recreate $100,000 a year, pre-tax cash flow is very, very difficult, if not impossible. So benefit security becomes an issue for executives. What if there was a plan that had little to no expense to the bank, has an asset treatment, not a liability treatment on the balance sheet, that offered income tax-free distributions to the executive and was insulated from bank ownership changes? Well, there is a plan, and it's called split dollar loan. Split dollar loan is not new. It's been around for several decades. The tax regulations that we'll reference have been finalized since 2003. And the name comes out of those regulations. They refer to it as loan regime split dollar. Split dollar loan is more friendly. Regime always sounds tough. So split dollar loan. Again, keeping in mind why this is so dramatically different is when you think about the long-term executive benefits, those wealth accumulation benefits that you can offer, you have deferral plans, you have SERP plans. Those, again, are mere promises. No specific asset has to be acquired or can even be formally used to fund those type of benefits. Yes, banks have purchased BOLI over the years as an informal offset to those things, but you should be able to justify offering a SERP benefit with or without BOLI, you should be able to justify buying BOLI with or without a SERP benefit. Two different things. But there are two specific forms of benefits that are very much product-based. They require the purchase and use of a policy, an insurance policy. They're actually owned by the executive. So REBA, Restricted Executive Bonus Arrangement, which we will not talk anymore about today, and split dollar loan. First question that always comes up, especially when I hear loan with executives, is, well, how are the regulators going to respond to this? Well, the Federal Reserve actually has guidance dating back to the mid-1980s, and it predates the final tax regulations, which we'll talk about in a second. So we spent some time with the regulators, getting them to affirm and update that where they could, and they've clarified, confirmed actually, that split dollar loan is a compensation tool. It's an executive benefit, and it is not a rego loan, as long as two conditions exist. First, the executive cannot have any personal liability to the bank beyond the life insurance policy cash values or death benefits. So the sole source of repayment is the life insurance policy. And number two, because it's a compensation element, not meant to be an investment, if you will, it's got to be a 0% loan. So whatever the bank puts into it, they'll get fully reimbursed or recovered, if you will, but no return on that. Actually makes modeling a lot simpler. Analysis is a little different, and again, many cases better. We also have the interagency statement. Many people are familiar with this through BOLI, so Financial Institutions Letter 12704. It's also OCC 2004-56. It has a lot of information about the pre-purchase, about the monitoring, but in there it gives 4 instances that a bank has the right to have an interest in insurance, and one of them is insurance taken as security for loans. So this actually happens frequently in the commercial lending context. I serve on the board of a bank, and I know that oftentimes we'll take a collateral interest in an insurance policy when we make a commercial loan. It happens all the time. I promise you, most banks do not think about that limited transaction in the same vein as they do a BOLI transaction, primarily because it's usually 3 to 5, 5 to 7 years for a commercial loan life, whereas BOLI might be 30 to 40. Well, split dollar loan could also be 20, 30, 40 years, longer in nature. So we think the best practice is absolutely to consider split dollar loan along with any BOLI holdings, sort of approach the analysis the same way. We also have the regulations, the final tax regulations from September of 2003. And they're a couple hundred pages, maybe 108 pages, single spaced. But what it boils down to is this: where employer payments to acquire a life insurance policy are supposed to be repaid, contractually repaid from the life insurance proceeds, those employer payments are not current income to the executive. They're a loan. From the IRS's perspective, from an income tax perspective, since they're a loan, it ought to account for some market interest rate. And typically that's the applicable federal rate, or AFR, for the month that the bank makes us some advance. So if you did an advance today, March of 2022, that rate is 2.14%. Well, we know the Fed says you can't have any interest back, so it's got to be 0%. So what that means is, from an IRS income tax perspective, you're going to have below market interest, and the amount of that has to be imputed to the executive while the arrangement's outstanding. Again, not terribly complicated. There's mechanics for that we can address. In fact, it makes it a lot simpler in some respects to model. So here's what I'm talking about schematically. Again, we have a loan to the executive to acquire the policy carried as an asset. Pre-retirement only, we recommend gross up bonuses to cover the tax obligation and that below market interest. So the out-of-pocket, if you will, for the executive is 0. But we want to make sure those end upon termination of employment, because we don't want to have to accrue for anything that continues after retirement. Executive is going to take those loans, or preferably a one-time loan event, and allocate it to the policy. First year's premium will be paid, And to the extent that we can, we will prepay subsequent premiums into a premium deposit account. Those are non-commission, non-load. It's just a deposit account, usually held by the insurance company, but could be right there at the bank. And it's just a mechanism to avoid the rising AFR that should be coming down the road for all of us. So we'll get into that a little later. Obviously, these policies and any premium deposit account are collaterally assigned back to the bank. That's the source of repayment. So we have a very strong lien, if you will, on those assets to prove and affect your repayment. And when the time is right, however the agreement is structured, we've got the income tax-free cash distributions, and it is life insurance. Father Time will always win at some point. Whatever death proceeds remain after repaying the bank go to the executive's beneficiaries. So why we use life insurance? One, that individuals own is the tax code has just favored it, highly favored it for 100 years. Tax deferred growth, tax-free distributions, tax-free life insurance proceeds at the end of the day. Now we're introducing an employer to pay for it in a way that even makes tax benefits better. Many states, like here in Illinois, also provide additional protection against personal creditors. So benefit security is greatly enhanced. And of course, we have these tax regulations and the bank regulatory guidance that makes it more favorable on the income statement and the balance sheet than other alternatives. In order to do split dollar loan, because it involves an insurance policy, insuring the executive, owned by the executive, we've got two must-haves. First and foremost, you've got to be insurable. So if you're not insurable at a reasonable risk class, it doesn't mean you're squeaky clean health, but reasonable risk class, the economics just don't work. Or if you're uninsurable, clearly it doesn't work. So first thing we need to flush out is what is a reasonable risk class that we can use for that executive. And number two, these insurance policies have high cash value, but they're not designed to fund and have a distribution in the first 2 or 3 or 4 years. Preferably, we want at least 5 years before we need the first distribution to the executive. Now, that's different from when the executive might retire, when he or she might vest. We can hope those dates occur early, even immediately in some cases, but it's that waiting at least 5 years before that first distribution that's meaningful. So again, let's go back to that example of the 50-year-old, and I'm gonna assume a standard non-smoking male. We're targeting $80,000 a year from the split dollar benefit. Recall that the SERP benefit was $100,000. Why the difference? Well, the SERP benefit of $100,000 is taxable. The split dollar loan distribution is income tax free. So there's some rationale to have an adjustment to create some tax equivalency between the two streams of cash flow, if you will. We recommend 20% to do that for two reasons. One, the executive shoulders policy performance risk. When we design these things, we use interest rate assumptions that may or may not hold true. So if the policy underperforms, the executive gets a smaller benefit. If it overperforms, they could get a stronger one. But since they shoulder that risk, we want them to get some benefit from a lower tax equivalent rate. Number two is the more favorable P&L impact that you'll see in a second sort of swings that over to the bank, and so therefore we kind of give some benefit of that P&L impact to the executive through this 20% rate adjustment. Again, we're using the March AFR of 2.14, and we're not planning on any repayments during the executive's lifetime. In other words, this isn't modeled and intended to stay outstanding until the executive dies. Younger executives, you can and should look at how you can, have a planned exit in 25 or 30 years. But when you get to that 50 plus range, you're getting right up against the actuarial tables, and it's tough to outmatch the actuaries. This is just a reminder. What you'll see now are some pages and parts of pages that we put in presentations. This is a reminder that the executive takes on the policy performance risk. We know the life insurance illustration rates are up here in the blue line, but we want to be certain, or at least have a higher degree of confidence, that we can deliver what's modeled. So we purposely lower those rates 50, 75 basis points. Some clients want to go further, but we purposely lower them for design purposes so that we increase the opportunity optimum performance, if you will. This is the AFR rate, and all that is to help us measure the below market interest. So as long as the loan outstanding, we have to report that below market interest income. You'll see that in a second. So big picture, what does it look like here? Well, again, if we knew we wanted to do the 80,000 a year for 20 years of 65, all the modeling shows that we need a bank loan of $1,047,933. In this case, it's a one-time advance. The one-time advance, not all of it goes into the policy. 1 year's of premium goes into the policy. The next 6 years in this model go into that premium deposit account. The sole purpose for that is so that we lock in that IRS rate, which again goes into calculating the below market rate. This is the projected tax-free benefits for the executive. 80,000 a year times 20 is $1,600,000 during his or her lifetime to spend, give away stuff in a mattress, and it is life insurance, assumed age of death at age 90. You've got a little residual benefit there that increases that as well. All of that 1.7 million of tax-free benefits comes at a cost to the bank of about $150,000. The leverage that you see there is just remarkable. On the executive side of it, let's talk about what that means for her. So here are our projected distributions. Actually, cash flow is a better way to say it. So it's designed to have no cash flow, either in or out of pocket, if you will, pre-retirement. Once retirement occurs, now we've got the $80,000 to spend, give away, or whatever. The life insurance benefit, it's at its highest during the pre-retirement years, but obviously as retirement occurs, as those distributions come out to the executive, the overall life insurance benefit comes down a little bit, and the residual amount to the executive's family goes down. It actually hits a low point the very last day you take the 20th distribution. It might gradually rise up again, but you can see that column there, very clear what it is, and that is net. That's not the gross death benefit, that's net after the bank has been repaid. And of course, vesting. When can the executive leave and what can they take with them? So the two bookends would be 100% vesting on day one. That's pretty rare to do that. Facts that might indicate that would be a long-serving executive who hasn't had a benefit before. Maybe they're giving up some other form of benefit, and this is the trade-off. On the other bookend is 0% until retirement age, or a better way to say that is cliff vesting at retirement age, and that's just unappealing. So usually it's somewhere in between there. I just gave you an example of a graded schedule that you might see over that time frame. And one more thing on that, let's say the executive is 50% vested when she leaves. What that means is she's locked in 50% of the 80 or $40,000, still starting at 65, right? If we tried to take that number sooner, there's 5, 6, 7 years of policy growth and accumulation that hasn't occurred. It would be far less than 40,000. So technically they could start sooner, but it's a huge haircut if they do that. So we kind of go through that as the opportunities occur. I talked about the below market interest. So $1,047,000 loan at 2.14% interest means that every year the arrangement's outstanding, you've got $23,219 of below market interest that's reportable by the executive. Pre-retirement, we recommend the gross up bonus. So the bank pays the gross up bonus of $15,500 roughly. The executive pays tax on the gross up bonus. Whatever's left then represents the tax that's on the below market interest. Net out of pocket is 0. Once we get to retirement age, or once termination of employment occurs, those gross ups end. So there's no ongoing tail for the bank to pay. And then into retirement, if the loan stays out there, we actually build into the model the ability to take more than the 80,000 to pay for those ongoing taxes. What does all this mean on the bank's income statements? Well, on the balance sheet, we now have an asset. The loan on day one, $1,047,933 and change. On day 5, on day 10, day 20, it's the exact same thing because no interest. Your collateral, though, is the underlying life insurance policy. Remember, there's no personal obligation by the executive here. So we know that at every point along the way, there's enough death benefit if that occurs, but GAAP doesn't allow you to look at death benefit. You have to look at surrender value. So here we have the illustrated cash surrender value at the end of the first year is $1,011,659, or about 97% of the loan balance. As those policy premiums get funded in there, it stays a little bit lower. And then depending upon the design of the executive, by years 5 to 10, somewhere in that range, the cash surrender value typically exceeds the loan receivable and you're fully collateralized. So the question is, what happens in those early years? Well, again, because there's no personal guarantee, GAAP would tell you that you have to temporarily expense that shortfall. So in this year, or in this model, the first year shortfall of $36,274 is a deferred compensation expense. The reason we say deferred comp is because it's not a tax item. It doesn't impact taxable income. It's just a temporary offset to the receivable. In year 2, you look at the change in the receivable. So actual cash value as it occurs will really drive this calculation. But in this model, even though the total shortfall has increased to 68,253, the change from year 1 to year 2 is only 31,979, and that's the P&L impact. By year 3, you can see it's starting to come down a little bit, and so now you're reversing those. By the end of the 7th or 8th year, maybe it's 9 years, depending upon, again, design issues, those temporary expenses have been fully recovered. So ultimately, that alone is zero impact. Because if the executive died the very next day, you recognize the 36,274 and she has a bad day the next day, it's fully recovered through death proceeds, so temporary. What's permanent, though, are the tax gross ups. So that $15,500 pre-tax bonus to the executive to help with the below market interest income is $11,052 after tax in this scenario. So those become permanent. And $11,052 times 14 years, that was that roughly $150,000 that you saw as the cumulative cost to the bank and its shareholders. In fact, let's revisit that. So recall that the SERP at the end of the day, when all benefits were paid out, cost the shareholders $1,428,000. The split dollar loan, same concept, all the benefits are paid out, death benefits are received, or just cash surrender values accrued, but the net expense to shareholders is $149,000. Is saving the potential to offset $1.2 million in expenses a fair trade-off to put a 0% loan in place to fund this? Not every organization will answer yes to that, but those that do are enjoying all the other benefits that come with it. One of the concerns that comes up in the eyes of board members sometimes is, hey, if we go to sell the bank, what does this mean in the eyes of a buyer? If you've ever been through the due diligence process as a buyer, you know that you're going to look at all of the assets of the seller. You're going to look at their real estate that they own, their branches, all those things, their investment portfolio, all their loans, obviously including this one. And you're going to affirm that the value they're stating is the real value. And maybe you'll negotiate different values, especially when it comes to real estate. But when it comes to this, we know that it's going to be worth $1,047,933. It's fully collateralized by the insurance policy. But a buyer might say, you know, I get it, but it's a 0% interest rate. It's an unknown maturity because we don't know if the executive is going to live for 1 year or 20. So we think we should discount it. Then the question becomes, what's the appropriate discount rate? How many years do you discount it? This is not intended to be determinative by any measure, but just to show that a buyer may do those kinds of things. And at the end of the day, whatever discount they might want to put on this may very well be immaterial to the transaction anyway. Again, we put it out there just to make sure that it's a conversation that somebody might have at some point, and we want to be clear on that. We actually have a very clear, design specs, if you will. It's a 2 to 3 page document that we drive you through talks about, well, again, if the initial funding event is meant to drive all of this in retirement, what are the other things that can occur? What if the executive becomes disabled? And the nice thing about split dollar loan is because the funding in almost all cases occurs on day one, having some accelerated vesting on change of control on disability doesn't impact the funding, doesn't impact the financials of the bank or the executive. It's just a question of how much you get to accelerate through there. So it's really cool to go through that design specs. And that becomes the template for the legal agreement that kind of goes around this as well. We have a conversation about which products to use. You can either use a whole life product or an indexed universal life product. They're not inherently better or worse, or well, I should say one is not inherently better or worse than the other, but they perform differently. Older executives, since our goal is to have the highest degree of confidence of getting the distribution, we tend to favor whole life as the main cash source, index for death benefit, and younger executives, it might swing the other way. So again, neither right away. We'll get into a discussion of that at the time. I talked about this earlier, but in terms of illustrating, be conservative. We're not looking to have the highest projected interest rates so that we have the lowest funding to go into it. We're looking for the high degree of confidence that we can actually deliver, in our example, the $80,000 a year for 20 years. So anywhere from 0.25% is a little low in my opinion, but from you want to cut it back, whatever the current dividend rate, whatever the current maximum illustration rate is, cut it back and have a conversation about what your comfort level. We've had some clients go all the way to a full percentage points less to be that confident. It's very critical to have ongoing servicing these things. I'd say more so than BOLI as an asset, mainly because the bank doesn't own this, right? They have an interest in it, but they don't own it. And so you want to make sure that all those things come into play. So reproject every year. Again, there's actual policy performance and assumed policy performance. Initially, it's all assumed. And each year that we have actual, we can capture that, lock it in, reapply those forward assumptions, and demonstrate that we're either on track or not for the targeted benefit. No one likes surprises. And if you need to make adjustments mid-course, you can do that. Sometimes those adjustments occur because the executive's compensation changed or position changed from what we intended or assumed, or the policy performance has failed and the board wants to do something about it. Obviously, carrier due diligence. Remember, the executive has no personal liability. The bank's sole source of repayment is the life insurance policy and its death benefit. So we want to make sure we monitor that carrier. And ratings are a starting point, but they are never enough. You want to make sure you look at other third-party sources like ALERT, ALIRT, S&P Global. We subscribe to both of those so that you can get a clear picture, not of where ratings are today, but what trends have occurred that might be concerning or reinforcing that this is a strong carrier that you have. And just like we do with our BOLI risk assessments, we summarize this every year in a memo to the board, and it covers 4 points. And it literally is 1 page and it's 4 bullet points. Has anything changed from the regulatory, tax environment, legal environment that would say split dollar loan is no longer appropriate? Has anything changed about the insurance carrier that should give you concern about your collateral? Is it on target in terms of delivering the benefit, yes or no? And relative to how much of it the loan is relative to your capital, are you within your own internal policy limits or the limits that the regulators want to stay within? Those 4 things need to be memorized at the board every single year. Memorialized, I should say. We get this question a lot is, well, I've got a SERP, had one for 5 years, had one for 20 years, about to put one in place for new executives. What do we do with that? Well, you might be able to recapture prior accruals. If you've had a SERP and you've been expensing that and have accrued liability, you may be able to recapture that, which of course is income to the bank. But we have to be very careful not to violate Internal Revenue Code section 409 Cap A. That means if you did that, it would be penalty taxes to the executive, not the institution, and it's awful. So the general rule is if you've got vested SERP benefits, we can't take them away. But if you've got unvested things that are years down the road before they would become vested, that is more of a conversation to be able to recapture those. What about the BOLI? We bought BOLI to finance my SERP. What do we do with that? I said it before and it bears repeating. BOLI is not the SERP. BOLI as an asset may have been acquired with the expenses of the SERP in mind, with enhancing the death benefit in a SERP agreement, but BOLI as an asset should stand on its own legs, just like the SERP benefit should have stood on its own legs. So BOLI is not the SERP, and if you get rid of the SERP, you're going to keep the BOLI. The bank just keeps it, and now 100% of the earnings, whatever the death proceeds are, instead of nominally going to offset the SERP, is now going to offset other benefit expenses, 401k, profit sharing, healthcare, group term life, et cetera. So disconnect in your mind if you're connecting those two issues. So we appreciate the opportunity to present this idea to you. It is not for every bank, but we are having some very good, fruitful conversations with a lot of your peers, and we invite you to follow up with us and let us show you how it may work for your bank. Again, thank you and have a great day.